Students and scholars, today we are going to talk about chapter number 9 for financial accounting. In this chapter, we are going to discuss various long-term assets. Some of them are we call property, plant, and equipment (PPPA), PP&E, sorry, and then there are natural resources, and then there are intangibles. So we will start with plant asset or PP&E, property, plant, and equipment. So the categories we have is basically there are three categories. These three activity categories. So these three categories are plant assets, natural resources, and intangible assets. Plant assets, we include land, building, equipment, furniture, and fixtures. So these are part of the plant assets. Other intangible assets are copyrights, trademarks, patents, and franchise. Among the plant assets, property, plant, and equipment, and the example of property, plant, and equipment is land, building, equipment, furniture, fixtures, automobiles, and there are other. Land is the only asset that never depreciates. Okay. They are different from other assets because have a long-term life. So life is greater than 1 year. So when you have a building, it may have a life of 50 years or 100 years. Automobile maybe life have 5 to 8 years. Computers and accessories may have a life of 3 to 5 years. Furniture and fixtures may have a life of more than 10 years. Some equipments and machines may have a life of 10 to 15 years. Okay. The cost of a plant asset allocated to an expense over the year, and the asset is expected to be used. So what we are talking about is when we purchase an asset, we pay either via cash or via notes payable or a bonds payable or via common stock. But when we use it, the use of the asset is an expense because, as we discussed in chapter 1 and 2, depreciation is an expense. What is depreciation expense? It's the use of an asset in the production of the revenue that we have earned by selling either the services or the products. And this allocation is necessary because the rule that we have talked about in chapter 1, 2, 3, and 4 about matching principle, that we have to match our expenses with our revenue. So that's why we have a depreciation expense. The allocation of a plant asset cost over its useful life, it's called depreciation. So whatever its useful life, it could be 5 years, it could be 50 years. Recorded at historical cost. So when you purchase, you always record it at a historical cost. What you have paid for that asset, so that would be considered historical cost. And this follows the cost principle that we discussed in chapter number 1. It states that acquired asset and services should be recorded at their actual cost. So for example, if you hire a consultant to help you in your business, so if you are paying $50,000 for the consultant, that is part of your expense in doing the business. But the actual costs also include taxes, commissions, and any other, and we'll see in great detail. So for example, the first thing we're going to talk about land and land improvement. Make sure you know that land and land improvements are two different assets. This assets, land, never depreciate. Land improvements do get depreciated. Okay. So the cost of land may include purchase price, brokerage commission, survey and legal fees. If there is any delinquent property taxes, what is delinquent? So the previous owner didn't pay the tax. Now you are assuming the ownership of the property, so you have to pay the past taxes. Title transfer fees, these are all included in your in the cost of land, including the cost of clearing the land. So whatever reason you are buying the land, you have to include this in the cost. The cost of land does not include fencing, paving, a sprinkler system, lighting and signs. All of those things are called land improvement. All right. There is one other thing that you may include in this list is sidewalks as well. These separate plant assets are called land improvement, unlike are subject to depreciation. Are two entirely separate assets, and land improvements are depreciated. That's what we just talked about. Now, construction of a building, if you are constructing a building, you would need an architectural fees, building permits that you have to pay to the city, contractor charges include labors, payment for materials, labor, and miscellaneous cost. So all of those things will be part of the building. If you are purchasing the building, then you have to pay the purchase price and cost to renovate the building to ready for its intended use, which may include paint, which may include putting a new fixture, it may include new carpet, things like that. When it comes to machinery and equipment, the cost of machine includes purchase price, transportation charges, insurance while in transit, sales tax and any other tax you have paid, purchase commission, installation cost, testing cost. All of those things goes into machinery and equipment. So for example, you bought a machine for $100 and their transportation cost was $10, insurance was $15, sales tax and other things were like $20, purchase commission was like $15, and installation cost was another $20, and testing cost is $10. So you now notice that this cost is not $100 anymore. It's become $2, $3, $5, $6, $8, $9, $190. So you will record this machinery at a historical cost. So instead of $100, you will say debit machine for 190, and you credit cash of 190 if you have paid cash. If you have paid any other thing, suppose for this $100 you paid a notes payable, so you would credit a notes payable, and for the rest you would credit the cash. Furnitures and fixtures include desks, chairs, filing cabinets, and the furniture and fixture include the purchase price less any discounts if you receive, and all costs ready for its intended use. So means if you have to pay the cost of bringing them inside the building, and you have to pay the cost somebody to place them at appropriate place, that everything would be included in the cost of the fixtures and furniture. How do we do accounting for long-lived assets? Account for acquisition cost means cost to acquire. Expense the asset over time, so at least depreciate. And determine the treatment of furniture future expenditure on the original. What future expenditures we talking about? So let me give you an example here. So there is a truck. If you are using a truck, you have to put a gas in it. Then you have to do what we call it oil change. You may have to brake service. You may have to do put a new wiper, for example, right? So all of those are a windshield, for example. So all of those things are considered expenses. regular expenses or operating expenses. But there are certain expenses, for example, putting a new engine. So putting a new engine is different than these because putting a new engine will increase or enhance the life of the truck. So if before putting an engine, the truck life was 5 years, and by putting a new engine, it adds 3 more years to its life. So that will be a difference. So this, it will be considered operating expense, these things. But this, it will be considered capital expenditure. And that capital expenditure increases the book value of the asset. So here an example we're going to do. Long-lived assets are initially reported at their acquisition cost, cost to acquire, and with also called historical cost, include cash or credit equivalent to given any other acquiring asset to get ready for its intended use. So for example, the gross price is $10,000. You receive a cash discount of $100, so you subtract it. You pay the sales tax of $500, and your related for expense are freight charges, installation costs, testing. So instead of $10,000, now it's costing you $11,400. Okay. Another important topic that you're going to talk about in the exam is a lump sum purchase. You're definitely going to have a question in the exam too, as well as in the final exam. The company may pay a single price for several assets. For example, you buying a land plus building plus equipment for say $300,000. How do you know that how much is the land, how much is the building, and how much is the equipment? The company must identify the cost of each asset. Usually they hire a consultant, and the consultant will tell them the price of the building is this much, the price of the land is this much, and the price of equipment. So that is not actually a price, as we call it estimated market value. Estimated market value is if you sell it this much, you should expect to receive it. So in this example, they told them that you have $60,000 for the land, building is $120,000 market value, equipment is $20,000. So therefore is $200,000 is the total. But how much did you really pay, right? So which is 30% of the total. So 30% of 60,000 is $57,000. 60% so that 30% we calculated by 60 over 200,000. All right, and the 60,000 we calculated is 120,000 divided by 200,000, and this 10% we calculated is 20,000 divided by 200,000. So what we are saying that the percentage of land in this market value is 30%, percentage of building is 60%, and percentage of equipment is 10%. So how much did we pay for this cost? So we paid actually a total of 190,000. This is what we paid total. So the total we paid is 190,000. So 190,000, 30% of 190,000 is 57,000. 60% of 190,000 is 114,000, and 10% of 919,000 is 19,000. So the total of this is 100. You paid $190,000, but the estimated value is $200,000. It could be less or it could be more, but they never never equal. It says the land has an indefinite use. That's true. Building useful life is 30 years, and the machine or equipment useful life is 8 years. So who basically comes up with these numbers? Either you can ask the person who is selling it, or you can hire an independent consultant, and they will tell you how long this equipment is going to last, how long is the building is going to last, and the land is always indefinite. Means nobody's going to steal or destroy the land. Expenditures related to land: all costs necessary to bring the land into condition for use to be capitalized. Capitalized means we're going to add them together and it will be the cost of the land. So property taxes on purchase, insurance, legal fees, fees to remove any old building or shack, and special assessments if it's charged by the city. So you will add everything together and that will be the cost of your land. Net recoveries from selling remove item reduce capitalized cost. So for example, you're removing this building, and by selling the debris of this building you got $10,000. So you have to subtract that $10,000 from the total. So first you add everything together. So for example, the land cost you $50,000, and then you add, so property tax were $5,000, insurance say was $1,000, legal fees say another $1,000, fees to remove the old building say $3,000, and a special assessment was $1,000. So now it's not $50,000 anymore. This is $55,000, $56,000, $57,000, $60,000, $61,000. Now you sell the debris of this old building for $2,000. So you will subtract $2,000, and now the land is $59,000. So that would be the historical cost, that the cost that you're going to record the value of the land. So you're going to say debit land at $59,000, and you're going to credit cash for $59,000. Okay. Leasehold improvements are accounted for separately, and we will discuss it when it comes to leases. Depreciation. Other than land, so land does not get depreciated, a plant asset cost must be allocated to the periods of the plant asset use. Means we are going to allocate the expense over a period. It could be month or quarterly or a yearly. The period of depreciation is the useful life, which may differ from its physical life. So useful life is not equal to physical life. Useful life is calculated by your accountant, your external accountant, or it could be comes from the company who is selling it, a vendor. They can tell you that, oh, if you're going to use this 24/7 for producing that much equipment, it may last 3 years. However, the physical life is 5 years, for example. But we always depreciate based on useful life, not on physical life. The company must also estimate the asset salvage value. Salvage value means value of asset after the useful life. What will be the salvage value? Is it going to be $5, $0, $500? We do not know. Assets, the end of its useful life. All right, distinguish between capital expenditure from an immediate, or as I say, operating expenses is the same thing. So capital expenditure increase the asset capacity or extend its useful life. And capitalized means the cost is added to an asset account rather than being expense immediately. So what we are going to say, if I'm putting a new engine in my car, that will increase the life of the asset. So what I'm going to say debit truck for $5,000, and we're going to credit cash for $5,000. So that's, you will increase only at one point in the life of the asset when it's increasing the capacity or capability of the asset. Depreciation is not valuation. What does it mean? Depreciation is a systematic allocation for matching expenses to revenue recognition. Like I said, we have a revenue recognition principle and expense recognition principle. We must recognize the revenue in the period in which it is earned, but at the same token, we must recognize all the expenses that has been incurred in making that revenue. So that's why depreciation is a systematic allocation. Imagine this way: you are a baker and you have a machine that produces a cake for you. So you paid $5,000 or $30,000 for this cake making machine, and you're going to plan to use it for 5 years. So you have to allocate that $30,000 over a period of 5 years. Depreciation is not intended to align the book value of an asset to its market value. So the book value of the asset would always be different from the market value. A book value of an asset is calculated this way: historical cost minus accumulated depreciation, right? But what is a market value? Market value is given to you at any given time, at any given time by an assessor. The person who's going to assess will tell you. So for example, let's take a cake making machine. If there is a fire and cake machine is destroyed, the book value of the asset may be $20,000, but the market value would be much less than the $20,000 because it was destroyed by the fire. Capital and revenue expenditure. Accountants divide spending on plant assets after acquisition into two categories. One is the capital expenditure, increase the asset's capacity or efficiency or extend the useful life. Includes extraordinary repairs, repairs that extends the asset's useful life. Revenue expenditure, operating expenditures or operating expenses incurred to maintain the asset's working order. Like I gave you an example of oil change, windshield change, lights, bulb that needs to be changed, tires needs to be changed, brake service. These are all operating expenses or day-to-day expenses. Okay, the example of capital expenditures are major engine or transmission overhaul, modification for new use, addition to storage capacity, anything that increases the life of asset. Let me give you an example of a truck. For example, you haul furniture in a truck, and you get paid say $30 an hour, but you have been asked to haul either the seafood, dairy, or fruits or vegetables, but you cannot do it because your truck does not have refrigeration capability. So what you do, you install the refrigeration system in your truck. Now that has changed the capacity and capability of your truck. So now you can, and which gives you say $50 an hour for transporting fruits as milk, dairy products, vegetables, or seafood, right? And so that's why, since you have installed a new refrigeration system, change the capacity or capability of the system of the truck, therefore it will not be considered a ordinary expense, it will be considered a capital expenditure. Revenue or ordinary expenditures are repairs, oil change, lubrication, maintenance, replacement of tires or windshield or paint job. These are all considered. They are all considered operating expenses, and these are reported in the income statement. And these are reported in the balance sheet. Okay. So capital expenditures reported in the balance sheet, and the revenue or ordinary expenditure reported to the income statement. Depreciation match the expense against the revenue generated from using an asset. All asset except land wears out, so they are used, so we have to depreciate them. Some asset may become obsolete before they wear out. An asset is obsolete when a newer asset can perform the job more efficiently. So again, it's a subjective decision. Either you can take it as an owner, your accountant can take it as, or when you replace something which has, in your opinion, become obsolete. Obsolete means less efficient, if you want to call it. For example, I'm personally using iPhone 8, for example, and iPhone 15 has already hit the market. So if I move to iPhone 15, I'm sure it will have everything new and it will be much more efficient in doing the job. All right. Now we're going to talk about factors in computing depreciation. One is the capital cost or historical cost, estimated useful life, and estimated residual value. This one is not an estimate, but these two are estimates. So cost minus estimated residual value is called depreciable cost, or some places you may read depreciable basis. So there's three things that we need: historical cost, useful life, and residual value. Useful life and residual value is always an estimate, and historical cost is what you have paid for that asset. There are three types of depreciation method. One we have already discussed in chapter 1 and 2, which was straight line method. The two new ones we are going to talk about is unit of production method and double declining method. Double declining method is considered accelerated method, and unit of production is considered most accurate method. Now, which one a business should use? It depends on the business. Some businesses, for some assets, they use the straight line method. For some, they use the unit of production method, and for some, they use double declining method. About 80% of the companies use a straight line. Okay, it's easier to use. Depreciation expense is reported on the income statement. We have already discussed this. The book value of the asset is cost minus accumulated depreciation, and it's reflected on the balance sheet. And we talked about it. This, for example, this is a long-term asset, and right below the long-term asset, there will be accumulated depreciation account about the long-term assets, which is keeping. So for example, this is $100,000 asset, and so far you have done $20,000 worth of accumulated depreciation. So the book value would be 100 minus 20, $80,000. Now we're going to talk about an example. Assume the cost of equipment is $5,000, has a 3-year useful life, which is an estimate, and a $500 salvage value. So annual depreciation would be what? 5,000 minus 500 divided by 3. So that is $1,500 per year. All right. To record the depreciation expense, what we do, we debit the depreciation expense as $1,500, and we credit accumulated depreciation at $1,500. Here is what we call it a depreciation schedule. It's an example of depreciation schedule. This is something you may have to make at work if you get a job in accounting. So you first year, the balance was $5,000. Your annual depreciation was 15. So accumulated depreciation is 1,500. The asset value is 3,500 at the end of the first year. Second year, you can take the balance on this account is still going to be 5,000. You take the annual depreciation of 1,500. Now your accumulated depreciation is 3,000. Your book value is 2,000. In the third year, you again take 1,500. Your total accumulated depreciation is 4,500, and asset book value is 500, which is again the residual value we have calculated. The next one we're going to talk about is unit of production method. Allows a varying amount of depreciation each year based on the asset use. So this is based on the asset usage. When a plant usage varies by year, the unit of production method better matches expense with revenues. Okay, so it is very much the same. Instead of the useful life, you have how much you have used. 10,000 miles you run this truck, 15,000 miles, 20,000 miles. So every year the usage will change and you will calculate accordingly. Double declining balance method, it is an accelerated depreciation method. Expense more of the asset cost near the start of the asset life and less at the end of its useful life. So if you want to take more depreciation upfront in order to save some money on tax, basically, so you take double declining method. And is the main accelerated method of the is the double declining method. The balance multiplies an asset decreasing book value by a constant percentage that is twice the straight line depreciation rate. So assume equipment costs $5,000 with a 3-year useful life, 500 salvage value, and is depreciated using a double declining method. So the book value at the beginning of the year multiplied by the double declining balance. So the first year, your acquisition cost is $5,000. There was no accumulated depreciation at the beginning of the year, so there will be none. Book value was 5,066. So why we are taking 66? When we took the same example for the first year, what was it? Our 1,500 divided by 5,000. So 1,500 divided by this will give you the remaining life of 66.67. This is 33%, but it's 1 minus the 33.66 percent, so that will give you 67.67%. Okay. The formula at some other places you're going to say for double declining basis is 1 over life multiplied by 2. So for example, what is 1 over life is 3 years multiplied by 2. So it's 2 over 3. The 2 over 3 is 66.67%. So the 67, so the first year you're going to take 3,334. Next year you're going to subtract this. So you have a book value of 1,666. You're going to take again the 66.67%. So the second year you have 1,111. Third year, this is your accumulated depreciation. This one, and this one will give you this. The remaining book value is 555. You multiply again, but you're taking only 55. Why? Because in double declining balance, you never take more than the depreciable base. So what is a depreciation? So double declining balance never depreciate an asset beyond its depreciable base. And what was the depreciable base here in this example? It was 5,000 minus the 500 value, salvage value, so that gives you 4,500. You have already depreciated 4,445. This much is left to the final year. It is usually what we call it a value which we can calculate by subtracting how much we have. So we have already, so 5,000 is the total. We have already depreciated 4,445. We left with 555, and we minus the 500, the salvage value out of it. So we left with 55. So that's the only depreciation expense we can take in the third year. So you notice the majority of the depreciation is coming in the first year, and then less on second year, and the third or the final year is the least amount. So that's what depreciable. So what when you increase the expense, increasing the operating expense reduces your profitability or net income. When the net income is less, you pay less tax on it. This is another important topic, partial year depreciation, because whatever we have studied so far, that you are buying the asset always on 1/1 year 1, right? But it does not happen in real life. In real life, you can buy at any given time. So for example, There is a half month convention is used for asset purchase during the month. Record the depreciation for the entire month if the asset was purchased on or before the 15th. And A, do not record the depreciation in the purchase month if the asset was purchased after the 15th. So for example, you are purchasing an asset on January 13th, then you will take the half month on January 13th for the month of January, half of the depreciation expense for the month. But if you are buying the asset on the January 17th, then you will not take the depreciation in the month of January. You will start your depreciation first of the next month, which is February. Changing an estimate of a depreciable asset, absolutely you can do that. Business may change its estimated useful life or estimated residual value. For example, you change your life from 3 to 5 years. You think in the beginning that it's going to last 3 years, but you realize the machine is good, it may last 5 years, so you can move that. You can also estimate the residual value at the end of 3 years. It was $500, but after the end of 5 years it will be zero. If this happens, the business must recalculate depreciation expense. Current year and future depreciation are recalculated. Prior years are not restated. So in this case, you are not going to change anything what you have already recorded, but from the point that you have selected that you are changing either the useful life or the residual value or both, you will calculate a new value of the depreciation expense, and you will do that. As the asset is used, business may change its estimated useful life or estimated residual value. It happens, we're not going to restate the prior year. Somehow it was listed twice. All right, reporting property, plant, and equipment. How do we report these things in our balance sheet? So property, plant, and equipment reported at book value on the balance sheet. It does not matter whether their market value has increased or not, or decreased even, but we're not going to make a change until we sell this, and we'll talk about it later. Companies may report plant asset as a single amount with the cost and the related accumulated depreciation disclosed in the notes. So like I show you in the previous page, there is one asset, a vanity account is keeping the historical cost of the long-term asset, and another account, an accumulated depreciation. We are keeping track of all the depreciation that we have taken during the use of this equipment or asset. And disposal of a plant asset, eventually an asset wears out and becomes obsolete. What they do, they discard the plant asset, they sell the plant asset, or exchange the plant asset for another asset. So for example, suppose there is an asset, all right, and the value, the book value of the asset is a historical cost minus accumulated depreciation. So your historical cost, suppose it's $10,000. Your accumulated depreciation is $2,000. So you subtract that, so that gives you net book value of $8,000. Now the selling price is $7,000. If the selling price or the market value is $7,000, you are sitting on a loss of $1,000. But instead, if it is $9,000, then you have a gain of $1,000. So that's the idea behind when you are doing it. Regardless of the type of, there are 4 steps. Bring the depreciation up to date and remove the old, dispose of asset and associated declaration from the book. So how are we going to remove this? So we are selling this, suppose we are selling it for $9,000. So what is coming? We're going to say debit, cash is coming at $9,000. What is going out? Our asset. So we're going to say our long-term asset is going out. It came at $10,000, so it will go out at $10,000. Now it has a $2,000 accumulated depreciation, so that will go out. So we're going to say debit accumulated depreciation of $2,000. Now we have $11,000 on this side and a 10,000. So we have to put 1,000 here, and we're going to say there is a gain of $1,000. Suppose if we are doing a loss, so we're getting a debit cash of $7,000, and we are crediting the long-term asset at $10,000. We also debiting the accumulated depreciation is going out at $1,000. So now we have 9,000 on this side and a 10,000 on this side. So we're going to debit another $1,000 over here, and that is our loss. Okay. Depreciation for tax purposes. IRS uses a MACRS table, and they provide that MACRS table for each kind of property. So they have a 3-year property, 5-year property, 7-year property, 39-year property, and I believe they have a 27-year property as well. And these, I think 5 years is for automobiles, 7 years for furniture and fixture, 39-year for the commercial building, and 3-year for computer related. So we have to calculate using that. And these days we all use software, so that MACRS is it's only used for taxation purposes. So as you say, MACRS is not acceptable for GAAP. So for GAAP purposes, you have to use either the straight line depreciation, double declining balance, or unit of production. You cannot use MACRS for GAAP. Natural resources such as oil and gas or any precious metal, these are include. Depreciation is, and we do not use depreciation. Instead, we use depletion. Depletion simply means, suppose you are buying an oil well and the geologist told you that you can get 1 million barrels of oil. So basically, when you start taking out the barrel after barrel, you are depleting the 1 million barrel that is in the well. So basically, instead of using what we call it the oil well, we do not call it depreciation, we use the term depletion for it. For example, you purchase a oil well for $1 million, and you pay cash $1 million, and a geologist told you the oil well has say 100,000 barrel of oil. So what is the per unit cost? The per unit cost is 1 million that you paid, and you are getting 100,000 barrel of oil out of it. So it's going to be $10 per barrel. So the depletion rate would be how many barrels you're going to take out, you multiply. So for example, you take out 20,000 barrels in the first year, so your depletion will be 10 multiplied by 20, 200,000. Okay. Intangible assets. Intangible assets are patents, copyrights, trademarks, other creative works. These are all the tangible assets. Intangible are purchased and recorded at cost. Most purchase intangible expense through amortization. So we do not use depletion or depreciation. For intangible assets, we use the word amortizing the cost. And there is a useful life in there. There is a useful life, but no residual value. Okay. Most purchase intangibles expense over its useful life. Only intangible with a definite life are amortized. Definite life means 5 years, 10 years, 15 years. Indefinite life, we cannot quantify. Okay, intangible assets with an indefinite life are tested for impairment annually, and impairment occurs when the fair value of an asset is less than its book value. So for example, another example for this is a goodwill. Goodwill is the value paid above the net worth of the company asset and liability. So for example, you are buying Macy's. All right. So Macy's has an assets worth $100 and liabilities worth $50. So what is a net asset? As net asset is asset minus liability, so it's 50. If you are paying $70 for this $50 Macy's, so you are paying 70 minus 50, $20 for the goodwill. So the goodwill is the value paid above the net worth of company assets and liabilities. It is recorded by acquiring company when it purchases another company for more than the market value of the asset. How do we record? And goodwill is not. So we're going to say debit. We're going to say assets. How many assets we getting? 100. And we're going to credit liabilities for 50, right? And we're going to credit cash that we pay is 70, right? So we're going to debit goodwill GW for 20. Okay. Now, what are patents? A patent is an intangible that is federal grant conveying an exclusive 20-year right to produce and sell. The invention may be a process, product, or formula. One thing we need to keep in patents, copyrights, and franchise or license, there are two things. One is legal life versus useful life. The legal life may be 10 years and useful life may be 5 years. So you always use the useful life to calculate the amortization of the asset. And amortization calculation is very simple. Suppose you pay $100,000 for this patent, you just divide by 5. So that means your amortization expense is going to be straightforward $20,000 for this particular patent. Okay. A copyright is the exclusive right to reproduce and sell a book, a musical composition, a film, another work out of intellectual property, and is granted the life for 70 years. For example, you created a song, and if anybody wants to use your song for any purposes, they will have to give you a royalty. Royalty is kind of a rent or money for the usage, and you will receive for the entire life. Say example, you created a song at the age of 20 until you as long as you live. Suppose you live to be 70, so you're going to receive the royalty for the 50 years of your life, and that beyond another 70 years your state or your children will receive the royalty for that song. Franchise and licenses are privilege granted by a business to sell goods or services under specified conditions. McDonald's, Subway, licenses granted by government to use public property in performing service, you have to pay for it. So I have provided another video on a extensive problem, end of the chapter problem that I have solved for you for this chapter. So make sure you watch the video as well, and please let me know if you have any question about any of those videos. I would be happy to answer all your questions. And please, again, thank you for watching this video, and please let me know if you have any question.